All right, welcome to the Trillion Dollar Show. This is June, what is today? June 10th, 2025. And I'm Neal, your host, founder of Tax Sherpa. Along with me is Fatma and Serena, these two of our great behind the scenes people. And this is the show where we try to save Americans $1 trillion. So right now, we were supposed to get a vote in the Senate last Friday on the big beautiful bill, or Make America Prosperous Again, whatever you're calling. I've seen people starting to call it OB3, which is the abbreviation for the big beautiful bill. And we didn't get a vote. So if anybody was paying attention, there was a spat that happened between Elon Musk and Donald Trump last week. Apparently, they had a falling out because Elon is saying that this is too much in spending and yada yada yada. Whatever the case, the Senate did not, in fact, vote on Friday, and they're still deliberating. And the administration is still saying that they want to have a signing ceremony on July 4th, which is less than a month away now. So we'll see how that goes. But the point that I try to make is that it doesn't matter how much the budget is for, because no matter how much is budgeted in an appropriations bill, they're going to spend that much and then some. And the only constraint we have on the spending that Congress, or more generally the government, does is how much they bring in tax revenue. I mean, there's other things. There's the import tariffs, and there's a couple other fees and duties that are paid, but the bulk of the money going to the federal government is from tax revenue of various stripes. There's payroll tax, there's income tax, there's corporate income tax, there's the estate tax. Those categories account for the vast majority. And the biggest two are individual income tax and payroll taxes. And those are about equal at around $2 trillion a year. So the only way to prevent them from spending more is to give them less. And that's where the $1 trillion show comes in. So my goal, my mission, is for people across America to spend $1 trillion less in taxes. Now, I'm willing to take $1 trillion over a couple of years. So maybe 250 billion a year over 4 years. That'd be fine. But that's how we're applying our part in restricting the downfall of the US dollars. Because as Congress prints more money, or as they appropriate money and the Treasury has to borrow and the Fed backstops the primary dealers into creating more reserves, however you want to look at the system, that's where inflation comes from. It's from additional money being printed. As inflation proceeds, US dollars become worth less, and that's going to be a problem. We are in the long run. It was one of John Maynard Keynes's famous quotes was that in the long run, we're all dead, which is, okay, true. But, we are now currently in the long run from when he was screwing stuff up 100 years ago. Now is the time to try to fix these problems. With that, we're Tax Sherpa, and what we do is we apply Wall Street level tax planning strategies to Main Street for small business people, individuals, all that sort of thing. I've been a small business guy my whole life. And so when I got into my own tax problems and I owed the IRS over $1 million, then I ended up fixing my problems and took that and started applying it to others. So been in the tax game here for over 15 years, worked on over 50,000 tax returns, and have seen pretty much all there is to see in the small business and individual tax world. This is the show where we go over tools, news, and then questions. Serena and Fatma have compiled a list of questions that have come in over the last little while. I don't know what they are, but we'll find out. But I do know the answer to all the questions. And Serena, what do you think the answer to all tax questions is?
It depends.
It depends. That's right. And that's the common answer from accountants and lawyers and things like that. And the reason is because it does depend. It depends on facts and circumstances. So what's true for you is not necessarily going to be true for the person right next to you with the same kind of expense. One of my favorite example of this is $100 shows up in your bank account. How is that taxed? And the answer is, it depends. What is it? First, you got to categorize what it is. Is it income? Is it a gift? Is it a loan proceeds? Is it you loaned somebody else and they paid you back? It could be any of those things. And then even if it is income, how much it's taxed is going to depend on other things. What else is going on in your tax world? What bracket are you in? What's your filing status and all this kind of stuff. So it really, really does depend. And all of the answers that I'll give over the next, 45 minutes or whatever it is, will all be different versions of it depends. But I'll tell you what it depends on. and we can figure out the nitty-gritty when it comes to all these different things. The big news, like I said, right now is that we're still waiting on the Senate to pass the big, beautiful bill. I think something will pass, and then they're going to have changes. Right now, they are talking about the SALT cap, state and local taxes. So under the old Tax Cut and Jobs Act 2017, state and local taxes were limited to a $10,000 deduction, no matter how much you actually paid. That's going to include your state income tax, your real estate property taxes, and things like that. And the current rumor is they're going to raise that to $20,000 if you make less than $400,000. But there's a lot of back and forth with that particular item. But whatever the case is, there's going to be changes from the House version. And then the House and the Senate will have to get together and reconcile that. And then there'll be an actual bill to present to the president. So that's the big thing right now. And originally, we were talking about getting a bill done by April. That went by the wayside, and then it was by Memorial Day, and then that went by the wayside. Now they're saying July 4th. And the problem with this is that these are pretty big changes. So in the big, beautiful bill, there is the no tax on tips thing. There's the no tax on overtime thing. There's changing the QBI deduction from 20% to 23%. There's the MAGA Trump accounts for newborns and people, kids under 8. So there's a lot of changes. And the later we get in the year, by the time this thing passes, the less time we have to react. We're already proactively looking at things, but we can't make any firm moves because we don't know what's actually going to happen in the legislation. But we have to keep our fingers on the pulse of things and see, if this does pass, then we'll have to do X, Y, Z for these 17 different clients. So those are all things to be mindful of. And the later in the year, the harder it gets. So hopefully we will get something passed soon, or they'll just drop it, one or the other, as long as we get a resolution soon. All right. With that, that's all the news. I have made some tools for the last week. You can see it on my LinkedIn. Just search my name on LinkedIn. Next week, on Monday the 16th, is Q2 quarterly estimates are due. And I made a little tool to figure out what your quarterly safe harbor amount is, and then how much the penalty will be if you don't pay it, which some people choose to do because they'd rather keep the money in their pocket and pay an extra 7%, on that quarterly estimate by keeping it and not paying it in. So that's a business decision to make if that applies to you. Obviously, with our clients, we've already prepped all that ahead of time, so you don't have to worry about it. But if you're not one of our clients, then yeah. So with that, let's jump into the questions. What do we have up first?
Looks like a question just came in. A client wants to know, what's your favorite way to help a client lower taxes without touching payroll or retirement?
Without touching payroll or retirement. So is this like somebody who owns their own business?
Yep.
Okay. So the payroll and retirement is actually the last thing that we do, because the payroll really, when you really want to optimize it, it really depends on everything else that came before, because it's going to be an adjustment compared to the net taxable income. So all the things we do beforehand is really what we do a lot of. So, entity structuring is number one, always. From there, we move into reimbursement plans of various stripes. There's accountables, there's MERPs, there's Section 127 plans, all this kind of stuff. The Summit Strategy session would be next. And all of those are going to reduce taxable income. And that's the favorite stuff to do first. And then from there, it's going to depend on what's going on. So, client I was just working on before the show started, she had a 2023 filing as an S corporation, and she was asking if there was anything to do. So at first glance, I said probably not. There was income and there was expense and everything, but then I was reading through the tax return. And I was like, oh, there's a commercial van that was purchased, and what happened was that the other tax preparer, whoever prepared it, had listed it as a passenger vehicle. So if you're a passenger vehicle under 6,000 pounds, it's one set of rules. If it's a commercial vehicle over 6,000 pounds, different set of rules. And so, when I went through the analysis of this, this was an expensive commercial vehicle, and we're able to create a swing in the taxable income from positive 87,000 to minus 17,000. So it was a big swing, about $104,000 swing in taxable income just from that one change by recognizing what different rules apply to this asset. Now, obviously, that's a case-by-case basis. Not everybody has that every year, But when things do come up like that, then we like to take advantage of the rules and in the most advantageous way possible. So those are fun ones. All right, what's next?
Yeah, so we got a question from one of our client boss. So he asked, how much can we pay a kid without needing to file a W-2?
None. You still have to, you got to
Yeah,
file a W-2.
yeah.
So without paying taxes is a different question. So if you set it up right and you put your kids on payroll, you have to give them a W-2. That's just it. Now, if the taxable income is less than the standard deduction, you can skip the tax return because you don't have a filing. So in 2025, the standard deduction for a single person is $15,000. So if you've got W-2s of $12,000, just as a number, then technically you don't have to file. Now, if there's withholding, you should because you're going to get that money back. If you have non W-2 income for that same person, then you should probably still file because if there's investment income, weird things can happen with kitty tax and all those kind of things. Generally, encourage avoiding that. There's also a secondary consideration that if you go for college financing, if you have an UTMA or if the kid has assets in their own name, like a stock account or something, then that counts against them for financial aid purposes. But if it's in the parent's name, it doesn't. So interesting things that happen. So yeah, so you still have to file W-2, assuming that they're on payroll. But whether you file the tax return or not is optional. If you have an older kid who's doing more work and you're playing either the 401k game or the IRA game, a lot of times you can end up paying more than the $15,000. But then when it comes down to the taxable income after the adjustment for those retirement contributions, then you're under and you're still tax free. But in that case, you would still need to pay, or you would still need to file a 1040 to demonstrate all those things that happened. So if a kid has a W-2 of 20,000 and then put 7,000 into a traditional IRA, now their taxable is 13. And that's under the standard deduction, no tax, but you do have to file just to show what happened. But yeah, the short answer is if a kid is earning money from a company, you have to file W-2.
Alrighty. Looks like we have another question coming in. Someone wants to know, have you ever layered multiple escorts for one client and why?
Usually not. I've done it a couple times. So usually that's from adjust my camera here. Usually people come to us with that and it's kind of already set up that way. So the thing with escort is that there's the whole reasonable compensation issue. And that is easiest to deal with one time rather than I've got escort here, escort there, escort the other place. I'm going to take reasonable comp from this one, but not from that one. It just invites too many complications. So typically we'll have partnerships. A lot of people tend to go into joint ventures. They get syndications and whatever, and they're limited partners in 5 different things. And we'll say, okay, let's have all that feed into your one S corp, and then take reasonable comp from there. Um, uh, you know, and typically the S corp is going to be doing its own thing as well on top of all that. So yeah, I like to avoid it if I can, but it does happen from time to time, usually because things have already been created before they come to us. There can be situations where a married couple or father and spouse have different things going on. They each have their own S corp. That can happen. That's probably the only standard situation where we do that. But yeah, generally try
Yeah.
to avoid it.
Mm. Yeah, so one of our clients just asked something really interesting, boss. So if someone owns two businesses, when should we split their expenses or keep them together?
Yeah, so if you want to be really rigorous about it, each business should be allocated its own things depending on usage or percent time involved. So let's say you've got two businesses and you use your personal vehicle for both of them. You should keep two different lists of logs and say, okay, 30 miles today went to business A, 60 miles next week went to business B, and actually just do the apportionment instance by instance, and then you allocate appropriately. So that's the ideal way. Very few people actually do that because it does take that extra management work of handling all that. But that's what I'd like to see. And yeah, we'll leave that one there. Allocate accurately. That's the answer.
Okay, understood. So it looks like another question just came in, Neil. Someone wants to know what's one tax topic you wish more EAs or CPAs actually understood?
For those who don't know, EA is a enrolled agent. So
Yes.
CPA is an industry standard where there's a AICPA, which is the governing body, and each state has their own qualifications for becoming CPA certified public accountant. One of the modules of getting your CPA is tax, but they do other stuff. They do public accounting, which is not relevant to 99% of people. EA is an IRS designation where they, there's a series of tests, and if you pass all three versions or all three sectors, then you're considered enrolled by the IRS. We have both at Tax Sherpa. But yeah, what do I wish more EAs knew, more CPAs knew? And this is more of a general point, I guess. So when I came up in the tax world, so just back to my story for a second. So I owed all this money. I ignored it for years and years. They started garnishing my wages. So at the time, I was tutoring high school kids. So I went from making peanuts to nothing. I was like, oh, now I got to fix this because I had ignored it for like 2 years. And then in the process of trying to fix my problem, I ended up finding somebody who was able to help me. He was a former Wall Street tax attorney, and he helped me fix my problems. And in the process, I started working for him, and he started showing me, the kinds of stuff that he did. And, I was with him for about 10 years. The thing I did not appreciate at first, it took me years to realize this, was that the things I was learning there were very, very different than what everybody else in the tax world does. So most tax professionals, whether it be EA, CPA, ERO, whatever their destination is, they're focused on what we call compliance, which means filing the forms. Now, the forms do need to be filed correctly. That's true. But where I focus, where Tax Sherpa focuses, is on the strategy side, on the planning side. It's not enough to say, okay, client gives me papers, I put papers in forms, we file forms, and that's the end of it. But that's what the vast majority of tax professionals do. So what I wish they knew or understood or cared, it's hard to say which is the driving factor,
Yeah.
is that it's like, hey, you have an opportunity to work with your client to save them thousands of dollars. Thousands, sometimes it's tens of thousands, sometimes it's, six figures, seven figures. I've got, multiple stories of saving clients seven figures, but they have to be making more in order for that to work, right? Because there's only a percentage difference in things because taxes are assessed on percentages. Our kind of bread and butter is small business owner. We do entity structuring for them. We apply tax strategies and we save them 20, 30, 50 grand a year. Just kind of that's every day, right? So the one I was working on earlier will save her about 20 grand for 2023 just by that switch of recognizing the correct asset classification. Because she had already done some other stuff and she'd overpaid on other things, but there's only so much we can fix in arrears sometimes. But like one of my favorite stories is that a woman comes to me. This is back when I was at my old firm. We used to do all in person. So she comes to me. She brings her last three tax returns, and this is back in Florida. So tax return from 3 years ago. Address is in Fort Lauderdale, and I'm looking at a Schedule A, which lists all her itemized deductions. She's got a mortgage. Okay, normal stuff. And tax return from 2 years ago shows that she's in Lakeland, Florida, which is middle of the state compared to the southeast corner of the state. And looking through, she's got the mortgage and everything. Okay, things are kind of in line. Address change, that's weird. And then tax return from the prior year, address is back in Fort Lauderdale. So I was looking at this, so I was like, okay, well, the address changed, income remained roughly the same, all the other stuff remained roughly the same. So I asked her, I said, what happened with we going from Fort Lauderdale to Lakeland to Fort Lauderdale? And she says, oh, I took a job up in Lakeland and didn't work out, so I moved back. I said, oh, okay. And you've been paying the mortgage at the place in Fort Lauderdale the whole time? She says, yes. I said, okay. Well, what did you do while you were in Lakeland for a year? And she says, oh, I rented it out. And I was like, oh, okay. That's not on your tax return. And she didn't think to volunteer this information to whoever prepared her tax return before, and that person didn't notice or care enough to ask. I don't know. If somebody's got a mortgage and they move 200 miles away, you got to wonder what's happening. And sometimes the house is just empty. Sure, that happens. I did that. But ask the question, right? And for tax purposes, rentals usually create net losses. And that actually helps on the tax return because it's lowering your income. Whether or not the cash flow was positive or negative, because of depreciation, we're able to to push it into net loss. That reduces taxable income, reduces tax. So we did that. And we amended her return, say, hey, we forgot to include all this rental income and expense. And so, here's the modified tax return. And she got a refund of, I don't know, a couple grand. And it's just, it's not that the other person who prepared the return couldn't have done that in the first place. They just didn't ask. Did they not care? Did they not notice? I don't know. But that's what I wish more EAs and CPAs understood, is that you gotta do a little bit more than just filling out whatever your client gives you, because there are facts and circumstances that need to be determined and figured out and applied to each individual situation. And that's what part of what makes tax so difficult, is that everybody's situation is different. And so we gotta figure out what is true for this person and make sure that we accurately report. That's one of the requirements of tax returns. So we accurately report things to the best of our ability and knowledge, but then use your best ability and knowledge. So
Chiming in, Neil. So you
yeah,
would say to start with strategy first and then figure out the forms later, not
ideally,
the other way
yes. Yeah. Sometimes
around.
if you get a new client, sometimes you don't have that luxury. You say,
Right.
okay, well, what can we do now that you're in this situation? But going forward, absolutely. Strategy first, figure out where we want to go, and then do the forms at the end.
Understood. So taxes are not just about data entry.
Now, and I'll tell you, the people who just do data entry, they are not long for this world, because the AI systems are coming along and they are going to wreck those people. Now,
Yeah.
tax is a compliance industry, so there's a lot of regulations as to who can do what and security systems and all that kind of stuff. That's going to slow down the AI, but it's not going to stop it. So 5 years from now, there will be a lot of, not a lot, but there will be some AI solutions that people can use and just file the forms, but they won't be able to do the kind of strategic level work that we do, just because it comes down to operator error. We run into this with engineers a lot. So engineers, but as a group, are very smart, and they say, "Well, I can just read the form and figure it out." It's like, okay, maybe, but you don't know what you don't know, and so you don't know that this. So, like, as an example, first-time homebuyer. If you take money out of an IRA, you can take up to $10,000, and you could be exempt from the 10% penalty if it's used towards a first-time home buyer purchase. And so you read that and you say, this is my second house or my third house in whatever in my life. So I guess I'm not qualified for that. It's like, well, you have to know what home buyer or first time home buyer means. In the tax regulations, what first time home buyer means is the first time in has not owned a home in at least 2 years. So if you owned a house 4 years ago and then you were renting or whatever, doing something else, living with parents, something, and then you buy another house, you're a first time home buyer and you're qualified for that exemption, even though it's not the first time you've ever bought a house. It's understanding both the the text, as well as all the things that go around the text and the history of how things have developed, as well as what applies to your individual situation. So even if an AI were interviewing you, I'm because people don't understand the terms of art, I don't think they will do a good job at answering the AI in order to get the best tax situation possible. So it still takes a human touch at the very least. But the guys who are just filling out forms, that can be done by AI, and it will be done soon. I don't know if it's this year, next year, or whatever, but soon.
Yeah. So here's something just came through from a client, boss. So what is the safest way to pay a spouse or parent in the business?
Spouse almost never matters. So in very few circumstances does paying the spouse make a difference, because whether it's to you or whether to your spouse, then you're still a joint couple, assuming you're filing joint, and the income's going to be collected communally anyway. Paying parents different. Depends on what the goal is with the parent. So sometimes the parent needs credits for Social Security, Medicare. That happens a lot with immigrant families. They come here, parents are 50, kids are 25, and they start doing whatever kind of business activity. And the parents need to have paid in for at least 10 years of assuming they get 4 credits per year, skip over that technicality. But basically, they need to pay in for at least 10 years in order to qualify for Social Security, Medicare. Now, if you pay the minimum for 10 years and then you collect Social Security, your monthly benefit's going to be low. It's like $700, kind of low a month. So that's not really the main thing. The main thing is the Medicare. Because once you turn 65, you're eligible for Medicare if you have enough credits in the system and all this kind of stuff. And obviously medical care is very expensive and gets more expensive the older you get. So that's a key element. And you want to make sure that, if they're working for the kid's business, then pay them either on W-2 or 1099, depending on what the situation is. Usually W-2 makes more sense. And I'm not going to get into the difference between the two at the moment. However, if that's not the issue and the parents don't need those credits, then you want to look at potential other opportunities. So there are potential tax-free reimbursement kind of ways. Maybe you take advantage of 280A and you have renting their personal dwelling and make that excludable from taxable income. So there's different ways to skin a cat. And the biggest thing comes down to do they need those employment credits or not? And how much work are they doing and all those kinds of things. So it depends. But
Sure.
yeah, it's very much it depends solutions. But the two primary avenues are we want W-2 and we want to pay in for Social Security, Medicare, or do you want to take as much advantage of tax-free opportunities as possible first? So that's the key decision, depending on which way you're going to go down.
All right. It looks like we have a client asks, do you ever recommend cost segs on short-term rentals, or do you avoid it unless it's passive income?
No, so let's just give a little background on what this is. So if you have a long-term rental, and long-term is defined as the average rental period is greater than 7 days, or 7 days or greater, then it's automatically considered passive. And the exception to that is if you're a real estate professional and you're actively engaged in a trade or business. So for short-term rentals where the average stay is under 7 days, then by definition, just by definition of rental activity, you can look in the publications for it, it's not rental income, it's a trade or business by default. And so the question becomes, it's like, well, if I'm actively engaged in this trade or business, then that converts the income to be from being passive to being ordinary, which if you're a higher income filer, that's a huge difference because passive income is very limited. Either it's going to be limited to zero in terms of losses, or it's going to be limited to 25,000, depending on what your income is. But ordinary income is not limited at all. So if I've got a W-2 of $300,000, let's say, well, highly paid, whatever, I'm building a portfolio of short-term rentals, then I absolutely want to look at cost segregation, assuming I can demonstrate that I'm actively engaged, which is, there's material participation tests and all this kind of stuff. So if I can demonstrate that, then all of that loss that is created by a cost segregation study is now deductible against my W-2 income, which is fantastic. So yeah, that's definitely a strategy you want to look at if it's potentially available to you. So there's a lot of ifs, in all that. And what cost segregation is, for those who don't know, you buy a house, right? Let's say it's $500,000, but you're not just buying a house. You're buying land, you're buying a driveway, you're buying a structure, you're buying wiring, you're buying cabinetry, you're buying appliances, you're buying ceiling fans, you're buying fencing. All these different things are counted as different things when it comes to taxes. So cost segregation is when you get a study done on your particular property and it separates all those different assets into their different categories and assigns a value to them. And what that allows you to do is that instead of writing off the whole amount over 27 and a half years for residential or 39 years for commercial, it allows you to accelerate a subsection, those things that are in shorter lifespans into years 1, 2, 3, 4, 5, mostly in year 1 with bonus depreciation. And so if you buy a $500,000 piece of property, you might get $100,000 worth of depreciation in cost segregation studies. It's it's definitely worth investigating for sure. And as long as you meet those different criteria, then yeah, absolutely.
Understood.
All right. So here's one we got from a client recently, boss. So what is the best way to explain an accountable plan to a client?
Yeah, the best way that I'd like to explain it is if you've ever worked for anybody and you went off and you went to, I don't know, you took a client out for lunch and you paid with your credit card, it's $58.62. You hand in that receipt to your HR people, they give you a reimbursement on your paycheck. Same exact thing. That's what an accountable plan is. It's a reimbursement for employees, and owners are counted as common law employees under this definition, and it reimburses them for personal spending that is attributable to business purposes. And so there's a lot that can be done there typically, depending on the situation, of course. But yeah, uh, if you have a separate business that's not just you as a Schedule C, but like an S corp or a partnership or whatever, and you have a home office that you're using, then the expenses that are attributable to that home office are reimbursable under an accountable plan. So people talk about the home office deduction. Home office deduction is only for Schedule C unincorporated disregarded entity businesses. And if you have a different business type, then they fall under accountable plan reimbursements. And accountable plans are more have a wider scope than just home office. But that's just one of the common things that a lot of people do. Um, so yeah, so it's just reimbursing for stuff you've already spent that has business purpose. And that's it.
Okay, it looks like someone wrote in, Neil, and said, if a client's about to sell stock or real estate, a go-to plan to reduce capital gains.
The it depends. So if we're talking about stock, then first we want to look at what kind of stock. If it's just public stock, like Apple Computer or Tesla or whatever, then your go-to move is to look at tax loss harvesting. So tax loss harvesting is when you look at other things that you have in your portfolio that are currently in loss. And you're like, well, I've got this gain. Let's say I've got $50,000 gain. I got these other losers that add up to be $30,000 that I'm down. What I'll do is I'll sell the losers. That'll offset the gain from 50 down to 20, and I'll pay long-term capital gains tax on the 20, or short-term capital gains if it's a short-term thing. So that's number one. Number two, when it comes to real estate, is well, do we have a personal use exclusion? That's always question number one. So if you live in a property for 2 out of the last 5 years, then you get, as a single person, you get $250,000 of gains tax free. If you're a married joint, you get $500,000 gains tax free. So if you can meet that, that's always move number one. If you're less than 2 years, so let's say you have 1 year of occupancy during that 5 year period, the exclusion gets prorated down. So, it's still better than nothing. You can look at tax loss harvesting on stocks to counteract your real estate gains. That's potential. But then there's also other things to look at. So in not your average situation, but we have had clients who are heavily involved in cryptocurrency, and they have massive losses in cryptocurrency, and we can recapture, or we can capture a lot of those by strategic selling of those losers. And that gets, crypto gets very complicated because back in 2013, the IRS just kind of planted a flag in the sand. They said, we're treating it as property, which I think is actually mostly correct. But there are functions in cryptocurrency that do not have an equivalent in regular property. So, like, this bottle of water, this is property, right? I cannot stake this bottle of water. I cannot put this into a liquidity pool. I cannot do a lot of things that I could do with cryptocurrency. And so the analogy kind of breaks down in those situations. But there are some interesting tricks to be done there. There are other exotic kind of plans or strategies that you can bring in when it comes to capital gains, but basically that's getting involved in third party stuff. There are syndications you can join and all those kind of things that are going to generate taxable losses or capital gain offsets. Or depends on the situation. But that's very esoteric. It doesn't apply directly to the capital gain. It's just another thing you can layer in to help offset. So definitely number one, number two are tax loss harvesting, and then personal use exclusion on the real estate. So yeah, that's where we start. And then it just keeps on going. The rabbit hole keeps going deeper if you need it to be.
Yep. Alrighty, boss. So this one came in earlier. When should we tell a client to stop writing things off to avoid red flags?
It's a good question. So the biggest issue with, just writing things off is if you have a day job and you're creating losses. So if you are creating losses, then you have the first question is always basis. So basis means, do you have enough investment into this activity in order to justify taking this loss? So that's number one. Can you demonstrate that? Number two is it reasonable? Right. There's like a sniff test. We've seen people who bring us tax returns and say, hey, IRS is asking questions about this thing. It says, okay, send us the return. Let's see what they're talking about. It's like, okay, I made $125,000 W-2. I've got a $50,000 loss on my Schedule C. I look at the Schedule C, which is the unincorporated business, and it's got zero revenue and it's got $50,000 of expenses. And I said, you're stuck. This is not justifiable, at least unless you have a killer story, right? Just on the face of it, it's very hard to justify that because a tax return is telling the story of what happened during the year with your income. So what that story is saying is like, hey, I have a day job, I make 125 grand, I put 50 grand into this thing, whatever that activity was, and I lost it all. I didn't make $1. I didn't make any sales. Are you actively doing anything? It's like, well, your default assumption is going to be no. Another story I like to tell is around the corner from my house, there's a shopping center with a grocery store. So that's where I go often to get groceries. In the corner of the shopping center, next to the grocery store, there's this bay, and this company opened up. And what it was it was like those frozen yogurt places where you pour your own and then you weigh it, you put on whatever toppings, and you pay by the ounce or whatever it is. It was like that, but it was with flavors of popcorn. And they had these big, beautiful machines that I could see through the window because I never went in. And they had like the caramel popcorn, they had the cheddar popcorn, they had the regular, all these different things. There was like, I don't know, 8 or 10 different flavors that they had in these machines that you could then pour out and then pay whatever you wanted to pay. And so they opened, they had their big grand opening sign. I walked by, I saw it, I said, that's kind of interesting. I'm not interested, in buying any, but it's interesting. And I go home. Next week, I go to the grocery store, same thing. Next week. 3 months later, they're gone. So I don't know if anybody ever went into that store. I know those people invested tens of thousands of dollars in equipment and signage and building out of the shopping center suite. And for all I know, they made $0. So were they in business? Were all those assets in service? Absolutely. They were offering it to the public. The fact that the public didn't want it is a separate problem. But, so in that case, they might have had zero revenue and had $100,000 of expenses, and they should have taken all of that on their tax return. But it's a very unusual story. So you have to think about what it is what story are you telling on your tax return? If I make $500 and I have expenses of 50,000 or whatever, it's like, well, is that reasonable? Does that make sense that you would keep pouring money into this? Sometimes yes, right? But it's unusual, right? So you have to be able to justify, or you have to be ready to justify all these things in order to defend your story, because that's what an audit is. It's a request for explanation. It's literally the title of the form that you get sent, and they want an explanation of all these different things. And in those requests for explanations, they'll list whatever things that they're asking about. So you have to be ready and able to explain. And if you can, then great. If you can't, or if that thought keeps you up at night, then you're going too far, and you want to be more mindful of what it is that you're actually doing.
Alrighty. So don't do anything that gets you in trouble. Can't
Yeah.
prove it.
Yeah, I mean, there's a time and a place to be as aggressive as you want to be. If you do have the justification, and it does create a question, but you have all that all that backup, then yeah, take it. Just know that they might question it, and if they do, it's on you to provide that explanation. I've seen it go both ways, right? So I had one client who was doing the short-term rental thing actually, and they were using their own property. They would live in it, and then they would leave for a month, rent it out on VRBO, whatever. It was a luxury kind of place. And the taxpayer was a lawyer, and she had, she's a high-paid lawyer in California. She made 300 grand or whatever it was, and then they had this rental expense of $50,000 or whatever it was, and they really did. There was no exaggerations or anything. It just cost a lot of money, right? So they had to buy supplies. They spent like 30 grand on forks. It's crazy kind of things. And so the IRS questioned it. And they said, hey, explain to us this, that, and the other. And so, we talked it over and I said, okay, here's what you got to do. And you will win in the end because you are correct. However, it's going to be a giant pain. And in that case, they decided, we'll just pay the bill. And because it was worth more to them to go and do more business activity because they had another business they were starting to grow rather than spend 4 months, 6 months fighting with the IRS. And in fact, that was the correct decision because that business they went into made an extra $1 million. Whatever the tax bill was, even though they were correct, they were willing to pay it in order to just get it off their plate. So it's like, okay. Flip side, I had another client also with a short-term rental, got under examination, and they went back and forth, and it took 6 months, something like that. And then they just got a letter a couple weeks ago saying, hey, your return has been accepted as filed. Great. All the deductions they were entitled to, and everything is copacetic. It just kind of depends on how aggressive you want to be, how much hassle you're willing to put up with. I've had people who had contributed a lot of money to their church, like 20 grand, let's say. And that creates, it's not a huge audit risk, but it is a potential one. They might ask for charitable contributions and say, hey, prove to us that you contributed this $20,000. And this was an in-person appointment way back in the day. And so I'm putting stuff in. It's like, and it gets to that point where I start putting in 20,000 and the guy says, well, put in 12. I said, but you gave 20. And he says, yeah, let's just put in 12. I don't want to trip any red flags. It's like, are you sure? Because you're entitled to it. He says, yeah, I'm sure. And for him, it was worth the lack of stress in order to pay more in taxes and not have to have that worry over his head. Now, in reality, his worry should have been very, very low because everything was in the tax return was fine. But some people are much more worried than other people. So you got to balance out your personal comfort level with what it is that you're doing on the tax return. So I know it's a long-winded way of saying it depends, but that's what it comes down to. So whatever you're telling the government on the tax return has to make sense, and you have to be willing to back it up, and you have to be willing to sleep at night. Wherever those balance of factors comes out for you is where you should be.
Yep. So if you can't prove it, don't use it.
That's always true. It's almost whenever the IRS wins an audit, it's almost always documentation. It's very, very rarely are there real cases of tax fraud or things like that. It's like, can you prove that you used this money for this purpose and it had this, associated activity? A lot of people just don't keep good records. And, it's understandable. You're living life. But at the same time, that's part of your job is to be able to document all those things.
Understood. So, Neil, do we have time for one more question or how do you?
Yeah, let's do one more.
That's short. What's your position on funding our?
I like the whole retirement thing is subjective. So what I mean by that is that the if you do the math and you're invested in normal stuff like stocks and bonds and whatever, it really depends on your future assumptions as to whether it's better to just have a regular taxable account and invest there or to put money into a retirement plan and invest there with all the strings that are attached with that. So the so with that in mind, if your viewpoint is that putting money into those retirement plans is a good thing, then fine, because go ahead and do it. You have to keep in mind that all of these structures are legal wrappers that have been created by Congress. And theoretically, they could change the rules at any time. It's unlikely just because the backlash would be so enormous, but it is possible. So just keep that in mind. If you're a real doomer and you think the US dollar is going to zero and the government's going to seize everybody's assets and that kind of stuff, then it's like, well, maybe you don't want to do that. Maybe you just want to invest in something you have more control over, because when you put money into an IRA or a 401k, it's like, yeah, even if you have a self-directed one, there's still strings attached with that the government has put into place. And you got a tax break either now or in the future, depending if you do traditional or Roth. But that's the game that you're playing. So if you don't want to play that game, then okay, build in your assumptions about what happens into the future and use a non-qualified plan. 401k, IRA, QRP, 403b, 457. These are all qualified plans because they're qualified by the government as being retirement participation kind of stuff. With that, yeah, if subjectively you think it's a good thing to do, then yeah, I'm all in favor. If subjectively you think it's a bad thing to do, okay, invest somewhere else. The real important thing is to invest something, because Social Security is going broke. That's number one. Right now, the latest report from the Social Security trustees is that they're going to go broke in 2035, I think it is. And when I say broke, what that means is that they will have depleted all of their historical savings, and now the current Social Security taxes will not be enough to pay the current Social Security recipients. And so it looks like there will be, based on the projections, it looks like there will be enough money to pay about 85% of the Social Security benefits that are owed. So if that happens, everybody's getting a haircut on their Social Security benefits, or they're going to raise taxes, or they're going to create more inflation to print the money in order to pay those benefits. Some combination of those has to happen. And so, when it comes down to it, it's like, do I want to do that? Do I want to engage in that system, or do I want to have more direct control? And either one's fine by me. It's just whatever you like. So a lot of times when we're constructing a plan, by default, we'll kind of encompass all the 401k and IRA sort of stuff. But if somebody says, oh, I don't want to put into a retirement plan, I say, okay, and we'll take it out, and then we'll adjust whatever we can in order to make it as advantageous as possible. But yeah, there are definitely tax incentives to putting money into those plans. Whether you think it's worth it or not is up to you, and I'm fine either way. All right, with that, I think we're actually slightly over time, but I did want to share this little resource I made. I guess it was last week, the week before, and this is a tax strategy self-check. Is it coming up? There it goes. All right, so super easy, just a quick checklist of a couple questions, and you get to score yourself on, are you getting the thing that you think you're getting? So a lot of people think that they're getting tax strategy, tax planning, but really they're just getting compliance, and that's what we talked about earlier with the EAs and CPAs. Are you getting compliance or real tax planning? And if it'll kind of guide you through, are you sitting down with your tax pro, multiple times a year? Are they looking proactively? Do you just see once a year and say, here's my documents? All those kinds of things. And there's a couple warnings, warning red flags at the end. But it's what is it, like 14 questions or something? Not too terribly difficult. But if you want it, go ahead and email us, office@taxsherpa.com. We'll send you a copy, and you can figure out if you are getting compliance or if you're getting planning. So with that brings us to the end here, and we will do it all again next week. Next week is the 17th. I don't think we have anything conflicting, so let's plan on having a show next week.
Yay, awesome.
But we'll see you then. All right, have a good one,
All right.
everybody.
You too.
Have a good day.
Bye.